You know, people ask me all the time what I would do if I were starting over. They want to know how Charlie Munger would invest if he had to begin from scratch. No billions of dollars, no reputation, no access to special deals, no phone calls from CEOs begging for my capital. Just $10,000 and whatever knowledge I have accumulated over more than 7 decades of watching people do stupid things with their money. And I will tell you something. I think about this question more than you might expect, because the answer reveals everything about what really matters in investing. It strips away all the complexity, all the noise, all the sophisticated nonsense that Wall Street sells to justify their fees. It gets down to the fundamental question, what actually works? Here is the truth. If I woke up tomorrow and someone handed me $10,000 and told me this was all I had to build wealth for 2026 and beyond, I would not be worried. Not even a little bit. In fact, I would be excited, because $10,000 is more than enough to start building real wealth if you know what you're doing. And if you do not know what you're doing, $10 million will not save you. I have watched people lose fortunes that would make your head spin, simply because they did not understand basic principles. The principles that made me successful with billions work just as well with thousands. The math is the same. The discipline is the same. The patience is the same. The only difference is the number of zeros, and zeros are just decoration. But before I tell you exactly how I would allocate that $10,000, I need to explain my philosophy. Because if you do not understand the why behind the what, you will end up abandoning the strategy at the first sign of trouble. And trouble always comes. The market crashes. Stocks you own fall 30 or 40%. Something you were absolutely certain about turns out to be completely wrong. If you do not have a solid philosophical foundation, you will panic and make terrible decisions. I have seen it happen thousands of times. Smart people, educated people, people with advanced degrees from fancy universities, they all make the same mistakes when fear takes over. So let me walk you through how I think about investing. My philosophy boils down to a few core principles that I have refined over 99 years of living and 7 decades of investing. The great algebraist Carl Jacobi said it best, invert, always invert. Most people ask, how do I get rich? That is the wrong question. The right question is, how do I make sure I do not stay poor? When I look at investing, I do not start by asking what will make me money. I start by asking what will lose me money. What are the stupid things I must avoid? What are the traps that catch most investors? If I can avoid the big mistakes, the good results tend to take care of themselves. It is not about being brilliant. It is about not being stupid. And believe me, not being stupid is much harder than it sounds. When I purchase a share of a company, I am not buying a ticker symbol or a line on a chart. I am buying a fractional ownership stake in a real business with real products, real customers, and real cash flows. This might sound like semantics, but it changes everything about how you think and act as an investor. When you think of stocks as ticker symbols, you obsess over price movements. You check your portfolio 10 times a day. You panic when prices fall. You get euphoric when prices rise. You become a slave to the stock market's mood swings. When you think of stocks as ownership in businesses, you focus on the fundamentals. Is the business making money? Are customers happy? Is management competent and honest? Is the competitive position getting stronger or weaker? These are the questions that actually matter. I only invest in businesses I understand. This is absolutely critical. I do not care how hot a company is or how much everyone says it is going to change the world. If I cannot explain in simple terms how it makes money and why customers will keep buying its products 5 or 10 years from now, I do not invest. Period. End of discussion. This rule has saved me from countless disasters over the years. It kept me out of the dot-com bubble when everyone thought I was a dinosaur for not buying tech stocks. It kept me away from crypto speculation when people were getting rich on digital tokens. It keeps me focused on what I know rather than what I wish I knew. The size of your circle of competence does not matter. What matters is knowing where the boundary is. A lot of people think they understand things they do not understand. That is how they go broke. I want businesses with durable competitive advantages. I call these moats, borrowing a term from medieval castles. Just like a wide moat protected a castle from invaders, a competitive advantage protects a business from competitors trying to steal its customers and profits. The wider the moat, the safer the business, the more predictable the returns. Companies without moats are constantly fighting for survival. They compete on price, their margins get squeezed, they spend fortunes on marketing just to stay relevant. It is exhausting to watch, and even more exhausting to own. Companies with wide moats can raise prices. They can maintain margins. They can compound wealth over decades while their competitors struggle to survive. That is what I want to own. I insist on buying at a reasonable price. Notice I did not say a cheap price. I used to be obsessed with buying cheap companies, what Ben Graham called cigar butts. You would find a company trading below its liquidation value, buy it, and squeeze out one last puff before discarding it. But I eventually realized that it is far better to buy a wonderful business at a fair price than a fair business at a wonderful price. Wonderful businesses compound value over time. Fair businesses just sort of exist until they go out of business. I convinced Warren of this, by the way. It took some effort. He was stubborn about his cigar butt approach. But once he saw the math, he came around. And Berkshire's been built on wonderful businesses ever since. And probably most important of all, I think long term, my favorite holding period is forever. I am not trying to flip stocks for quick profits or trade around earnings announcements. I am not trying to guess what the Federal Reserve will do next month. I am trying to own pieces of businesses that will be worth substantially more in 10 or 20 years than they are today. This long-term orientation changes everything. It means I do not care about quarterly fluctuations. It means I can ignore market noise. It means I can be patient while compound interest works its magic. Most people cannot think past next week. That is their handicap and my advantage. So, with those principles in mind, let me tell you exactly how I would invest $10,000 for 2026. I have thought about this carefully, and I would split the money into 4 positions, not 10 positions, not 20 positions, 4. Diversification is protection against ignorance. If you know what you are doing, extreme diversification makes no sense. I would rather own 4 businesses I understand completely than 40 businesses I barely know. Each position represents a business I understand completely, with a wide moat at a valuation that makes sense for long-term holding. Let me walk you through each one. My first allocation, and this would be the largest, is $3,500 into a low-cost S&P 500 index fund. That is 35% of the portfolio. Now, I know what you are thinking. Charlie, you just said you pick individual stocks. You are famous for concentrated positions in businesses you understand. Why are you putting more than a third of this portfolio into an index fund? Let me explain, because this is important. When you are starting with $10,000, you have constraints that someone with $10 million does not have. You cannot own 50 different stocks because the transaction costs would eat you alive. You cannot properly diversify across sectors and industries with such a small amount. And frankly, most people, even smart people, are not going to outperform the market consistently over time. I have said this repeatedly. For most investors, low-cost index funds are the best choice. Not because they are exciting, because they work. But here's the thing. I would not just own an index fund. I would use it as a core holding that provides broad exposure to American business while I make concentrated bets on specific companies I think will outperform. The index fund gives me a stake in 500 of America's largest companies, including many wonderful businesses I could not afford to own meaningful positions in, with just $10,000. Companies like Microsoft, Amazon, Google, Nvidia, Meta, these are great businesses, and the index fund lets me participate in their growth without having to analyze each one individually. The S&P 500 has returned about 10% annually over the long run, including dividends. That means my $3,500 should double roughly every 7 years. In 20 years, it could be worth $24,000 or more, assuming historical returns continue. That is a solid foundation for any portfolio, and it requires zero effort, zero research, zero monitoring. I can set it and forget it while focusing my attention on the individual stock positions. There is another reason I would allocate heavily to an index fund starting out. It protects me from myself. The biggest risk in investing is not market crashes or recessions. It is making stupid decisions, buying something I do not understand because everyone else is buying it, selling in a panic when prices fall, getting overconfident after a few wins, and taking excessive risks. The index fund portion of my portfolio cannot hurt me. It is broadly diversified, low cost, and as close to a sure thing as exists in investing. When I inevitably make a mistake with one of my individual picks, the index fund will be there, quietly compounding, cleaning up my mess. Never underestimate your capacity for stupidity. I certainly do not underestimate mine. My second allocation would be $2,500 into Berkshire Hathaway. That is 25% of the portfolio. And, yes, I know this is the company I helped build with Warren, but I am not recommending it because of ego or self-interest. I am recommending it because if I could not be part of Berkshire, I would absolutely want to own it. Let me tell you why. Berkshire Hathaway is essentially a diversified holding company with stakes in more than 60 wholly owned businesses, plus a massive stock portfolio. When you buy Berkshire, you are getting exposure to insurance through Geico and General Re. You are getting railroads through BNSF, which moves about 15% of all freight in America. You are getting utilities and energy through Berkshire Hathaway Energy. You are getting manufacturing, retail, and dozens of other businesses. You are also getting exposure to our equity holdings: Apple, Coca-Cola, American Express, Bank of America, Occidental Petroleum. These are positions Warren and I selected over decades. It is like buying a mutual fund of businesses we have chosen, except it is structured as a corporation with no annual fees eating into your returns. No 2% management fee, no 20% performance fee, nothing, just ownership. But here is what really makes Berkshire special for a small investor trying to build wealth. The company is designed to survive anything. We have over $150 billion in cash and treasury bills. We have no meaningful debt at the parent company level. Our operating businesses generate enormous cash flow year after year, regardless of what the stock market is doing. We do not pay a dividend, which means all the earnings get reinvested back into the business at attractive rates of return. For a young person trying to compound wealth, that is exactly what you want. You do not want the money coming back to you where it will be taxed. You want it reinvested where it can keep growing. Let me put this in perspective. If you had bought $10,000 worth of Berkshire stock in 1990, it would be worth something like $400,000 today. That is a 40 times return, not from speculation or luck, from owning a collection of good businesses run by capable people who made rational capital allocation decisions over decades. There is also a psychological benefit to owning Berkshire that should not be underestimated. The company does not report quarterly earnings in the traditional sense. We do not give guidance. We discourage short-term thinking. This structure helps shareholders avoid the temptation to obsess over quarterly results and instead focus on long-term business performance. When you are trying to build wealth over decades, removing sources of anxiety and distraction is valuable. Berkshire is designed to let you sleep at night. At the current price, Berkshire trades at roughly 1.3 times book value. That is not expensive for a collection of businesses this high quality. Over the next 10 or 15 years, book value per share should grow at 8 to 10% annually. Add in share buybacks, which reduce the share count and increase per share value, and you are looking at potential returns that should beat the market over time. That is worth 25% of my $10,000 portfolio. My third allocation would be $2,000 into Apple. That is 20% of the portfolio. Now, Berkshire already owns a huge position in Apple, so I am getting significant exposure through my Berkshire shares. But I would still want to own Apple directly for a simple reason. I think Apple is one of the best businesses in the world. And when you find one of the best businesses in the world at a reasonable price, you want as much exposure to it as you can reasonably have within a diversified portfolio. Let me tell you what I love about Apple. First, the company has created an ecosystem that customers simply do not want to leave. Once you are in the Apple world with your iPhone, iPad, MacBook, Apple Watch, and AirPods, all seamlessly connected and integrated, the switching costs to move to a competitor are enormous. Not just financial switching costs, but psychological and practical ones. You lose your apps, your photos, your messages, your convenience, the way everything just works together. Very few people are willing to make that sacrifice to save a few $100s. This ecosystem creates incredible customer loyalty and recurring revenue. People upgrade their iPhones every few years like clockwork. They buy new AirPods when the old ones wear out. They pay monthly subscriptions for iCloud storage. Apple Music, Apple TV Plus. These services are growing faster than the hardware business and have much higher profit margins. Apple is systematically transforming itself from a hardware company to a hardware plus services company. And the services piece is incredibly valuable because it recurs month after month, year after year. Second, Apple's brand is arguably the strongest in the world. People are not just buying phones and computers. They are buying status, quality, reliability, membership in a tribe. The Apple logo means something. It says you value design and user experience. It says you are willing to pay a premium for the best. That brand loyalty allows Apple to maintain premium pricing even when competitors offer cheaper alternatives. And premium pricing means fat profit margins. While Samsung and other Android manufacturers fight over scraps, Apple captures the majority of smartphone industry profits. Third, Apple's balance sheet is a fortress. The company has over $60 billion in net cash, even after spending hundreds of billions on dividends and share buybacks over the past decade. During economic downturns, when other companies are scrambling for financing, Apple will be able to invest in innovation, buy back shares at depressed prices, and potentially make acquisitions. Cash gives you options, and Apple has more options than almost any company in the world. Fourth, Apple generates absurd amounts of free cash flow. We are talking about nearly $100 billion annually. That is, cash available to return to shareholders or reinvest in the business. And management has been extremely shareholder-friendly with that cash. They have consistently bought back shares, reducing the share count and increasing per share value. They have grown the dividend every year. This capital allocation discipline is exactly what you want as a long-term shareholder. Now, Apple is not cheap. At the current valuation, you are paying about 28 to 30 times earnings. That is a premium multiple. But I think it is justified given the quality of the business, the strength of the moat, the cash generation, and the growth potential in services over the next 5 to 10 years. My fourth allocation would be $2,000 into Coca-Cola. That is 20% of the portfolio. And I can already hear people saying, Charlie, Coca-Cola? Really? That is such a boring, old-fashioned business. It is not growing anymore. Why would a young person starting out put 20% of their portfolio into a slow-growth beverage company? Let me tell you why. Because this goes to the heart of what makes a great long-term investment. Coca-Cola sells happiness in a bottle for pocket change. A Coke costs what, $2, $3? For most people in the world, that is an affordable luxury, something that makes you feel good without breaking the bank. And here is the key insight. Demand for affordable luxuries is remarkably stable across economic cycles. During recessions, people stop buying cars and taking vacations, but they do not stop buying Coke. During expansions, people buy more Coke. The product is essentially recession resistant. I have lived through the Great Depression. I have watched every recession since, and I have never seen Coca-Cola struggle to sell its products. That kind of durability is rare and valuable. But stable demand alone does not make Coke a great investment. What makes it great is the combination of stable demand with the most valuable brand in the consumer products world. Coca-Cola's brand is recognized by 94% of the world's population. Think about that for a second. Nearly every human being on Earth knows what Coca-Cola is. That brand recognition took more than a century and billions of dollars to build. Competitors cannot replicate it. That brand allows Coke to maintain premium pricing relative to generic alternatives. It allows them to command shelf space in every retail outlet. It allows them to charge restaurants and entertainment venues for exclusive pouring rights. The brand is worth hundreds of billions of dollars, and it is Coca-Cola's ultimate competitive advantage. As long as that brand remains strong, and I see no reason it will not, Coca-Cola will keep generating reliable cash flows. And then there is the dividend. Coca-Cola has raised its dividend every single year for 62 consecutive years. 62 years through recessions, inflation, wars, everything. That is an incredible testament to the reliability of the cash flows and management's commitment to shareholders. At the current price, the dividend yields about 3%. That means my $2,000 investment should generate about $60 in annual dividend income, which gets reinvested to buy more shares. Here is why this matters for someone building wealth from $10,000. Dividend growth compounds over time in a way that is almost magical. Let us say Coke grows its dividend at 6% annually, which is roughly its historical rate. In 10 years, my $60 annual dividend becomes $107. In 20 years, it becomes $192. And that is before accounting for share price appreciation. But there is another reason I would own Coca-Cola starting out. The stock teaches you patience. It is not going to double in a year. It is not going to be the hottest thing in your portfolio. Some years it will barely move. But over decades, it quietly compounds wealth while paying you to wait. Learning to appreciate that kind of steady, reliable compounding is one of the most valuable lessons in investing. It keeps you from chasing shiny objects and making impulsive decisions. Now, let me talk about what is not in this portfolio, because that is equally important. Remember my first principle. Invert, always invert. Knowing what to avoid is just as important as knowing what to buy. You will notice I do not own any individual banks. Banking can be a great business, but it is complicated and opaque. Assets are marked at historical cost, not market value. Leverage is high. Risks can be hidden until they blow up spectacularly. The index fund gives me exposure to JP Morgan, Bank of America, and other big banks. That is sufficient. You will not see any speculative tech stocks, no recent IPOs, trading at 50 times sales with no profits, no artificial intelligence plays that everyone swears will change the world. Maybe they will change the world, but I do not understand their business models well enough to bet significant money on them. And with only $10,000, I cannot afford to speculate. I need every dollar working hard in businesses I trust. You will not see any pharmaceutical or biotech companies. I do not understand drug development pipelines. I cannot evaluate whether a clinical trial will succeed or fail. These businesses require specialized expertise I do not have. And you definitely will not see any cryptocurrency or meme stocks or day trading positions. I have been very clear about my views on crypto. It is not an investment. It is speculation. It does not produce anything. It does not generate cash flows. Its value depends entirely on someone else being willing to pay more for it than you did. That is not investing. That is gambling. And I do not gamble with money. I am trying to compound over decades. I have called Bitcoin rat poison squared. I stand by that assessment. Now let me talk about the discipline required to actually execute this strategy, because this is where most people fail. The hard part is not picking good businesses. The hard part is holding them through the inevitable downturns and not doing something stupid when everyone around you is panicking or getting rich quick on the latest fad. If I invested this $10,000 in January 2026 and the market crashed in March, my portfolio would fall maybe 20%, maybe 30%. My 10,000 would become 7,000 or 8,000. That is going to happen at some point. It is not a matter of if. It is a matter of when markets crash. It is what they do. And when it happens, I need to remember why I bought these businesses in the first place. Apple will still be selling iPhones during a crash. Coca-Cola will still be selling drinks. Berkshire will still own its businesses and have cash to deploy at bargain prices. The S&P 500 companies will still be generating revenue and profits. Nothing fundamental will have changed. Just the prices will have fallen because people are scared. And if I have truly bought wonderful businesses at reasonable prices, a market crash is a buying opportunity, not a reason to panic. Here is something else I would be doing with this portfolio. Absolutely nothing. I would not be checking prices every day. I would not be reading market commentary or watching financial news. I would not be obsessing over whether the Federal Reserve is raising or lowering interest rates. All of that is noise. None of it changes the fundamental value of the businesses I own. Checking prices constantly just creates anxiety and temptation to do something, and doing something is usually the wrong move. The stock market is designed to transfer money from the active to the patient. I would probably check my portfolio quarterly just to make sure dividends are being reinvested properly and to look for opportunities to add more capital. But that is it. The rest of the time I would be focused on my career, my relationships, my life. Building wealth should enhance your life, not consume it. If you are constantly stressed about your portfolio, you are doing it wrong. Let me paint you a picture of what this $10,000 portfolio could become over time if you stick to the plan. Let us assume the portfolio returns 10% annually on average, which is reasonable given the holdings. In 5 years, your 10,000 becomes 16,000. In 10 years, it is 26,000. In 20 years, it is 67,000. In 30 years, it is 174,000. And in 40 years, it is over $450,000. But here is where it gets really interesting. If you add just $200 per month to this portfolio, reinvest all dividends, and earn 10% annually, the numbers change dramatically. After 30 years, you are looking at over $500,000. After 40 years, it is over $1.4 million. That is life-changing wealth built from $10,000 and small monthly contributions. No lottery tickets, no get-rich-quick schemes, no speculation, just patient, disciplined investing in quality businesses. Einstein supposedly called compound interest the most powerful force in the universe. I do not know if he actually said that, but it is true regardless. Let me wind this down with some final thoughts on what this $10,000 portfolio represents. It is not about getting rich quick. It is not about beating the market every year. It is not about finding the next Amazon or Apple before anyone else. It is about owning pieces of wonderful businesses at reasonable prices and letting them compound for decades. It is about discipline and patience and rational thinking in a world that rewards none of those things in the short run, but all of them in the long run. If I had to start over with $10,000 today, I would be optimistic about my chances of building significant wealth over time, not because I am smarter than everyone else, not because I have access to secret information, but because I understand what works. I know that owning great businesses for long periods creates wealth. I know that starting early gives compound interest time to work its magic. I know that avoiding stupidity is more important than seeking brilliance. The portfolio I have described is not perfect. Someone else might allocate differently or choose different stocks. That is fine. What matters is the underlying principles. Own quality. Diversify adequately. Think long term. Stay disciplined. Keep costs low. And be patient. Do that with $10,000. Add to it consistently. Reinvest dividends religiously. And resist the temptation to do something stupid when markets get crazy in either direction. You will be amazed at what you can build over 20, 30, or 40 years. Not because investing is magic or because stocks always go up, but because owning productive assets in a growing economy, managed by capable people, and held through complete market cycles, is one of the most reliable ways to build wealth that humans have ever discovered. That is what I would do with $10,000 in 2026. And I would sleep well every night knowing I own pieces of wonderful businesses that will still be thriving in 2046, 2066, and beyond. That is all that matters.